You do something with money almost every day. But have you ever really stopped to think about what's actually happening behind it? You pick up your phone. You open your banking app. You look at a number. Not because you need the money right now, just to make sure it's still there. The number doesn't move. It looks solid. And it comes with a very familiar label. Available balance. The moment you see it, you feel a little calmer. You're not thinking about the bank. You're not thinking about the system. You're not thinking about where the money actually is. You only know one simple thing. If you need it, you can use it. Your paycheck arrives on time. Your rent gets paid automatically. You swipe your card, and it works. Everything runs smoothly enough that you never feel the need to question it. And that detail matters more than it seems. Because most of the time, money doesn't feel like a system. It just feels true. But almost no one ever stops to question this. A fact doesn't usually come with conditions. So pause for a second. If that money is really there in the way you believe it is, why does your access to it sometimes come with limits? You almost never notice those limits. Not because they don't exist, but because on normal days, you never hit them. You can withdraw cash. You can transfer money. You can pay for things. It all works fast enough that you assume it always will. But there's something strange about that. Money only feels instant and flexible when you don't urgently need it. You don't think about withdrawal limits until you try to take out more than usual. You don't think about processing time until a transfer gets stuck. You don't think about banking hours until you need to do something after hours. Those limits don't show up every day. But they're always there. You just don't see them until circumstances force you to. Think about moments when things stop feeling normal. When there's bad news in the market. When there's a crisis somewhere. When a lot of people start worrying at the same time. Suddenly, things that were invisible start to show up. The app feels slower. Transactions require more steps. Some money is technically there, but not immediately usable. Not because you did anything wrong, but because the system itself starts reacting differently. And this is the contradiction almost no one talks about. If your money is really there, why does access to it depend on timing, rules, and the situation around you? Why does everything feel smooth when you're calm, but slow down when a lot of people get nervous at once? That leads to a question very few people ever stop to ask. Is this system stable because it's strong? Or because it's rarely tested? Most of the time, you live inside what feels like normal. You get paid. You spend money. You make plans. And under those conditions, the system runs smoothly enough that you don't need to understand it. But normal isn't the only state life can be in. And when conditions change, you start to notice something important. What you've always thought of as your money is actually access to money, under certain conditions. The strange part isn't that those conditions exist. It's that you almost never notice them, until the moment they matter most. At this point, something important starts to stand out. Your money usually works smoothly, but your access to it isn't always the same. And that difference matters more than most people realize. So the next question is obvious. What is the bank actually doing with your money? Most people grow up with a very simple picture. You deposit money at the bank. The bank keeps it for you. And when you need it, you take it back. That sounds reasonable. And most of the time, it feels true. But try looking at it a different way. Imagine you pull into a parking garage. You hand over your car. They give you a ticket. You don't think your car is being stored. Not like it's just sitting there, untouched, waiting for you to come back. You understand something else is happening. The garage is managing the flow of cars. They're making sure space is used efficiently. And as long as nothing unusual happens, you trust that your car will be there when you need it. Banks actually work much closer to that model than to a vault. When you deposit money, you're not handing over an object for safekeeping. You're placing a claim into a system. A claim that says, under normal conditions, within a reasonable amount of time, you can access that money. You're not storing an object. You're holding a claim on a system designed to manage flow. That's why, in everyday life, You rarely feel like you're asking permission to use your own money. The system is designed so you don't have to think about it. But because of that, you also rarely notice something crucial. Banks don't exist to keep money still. They exist to keep money moving. They connect people who have extra money with people who need money to do something with it. They sit in the middle. They coordinate. They make sure money doesn't get stuck. If money just sat still in a vault, the economy wouldn't work. No homes would be bought. No businesses would open. No long-term projects would ever start. So the system is designed to keep money in a constant state of doing something, even when you can't see it. That doesn't mean your money disappears. It means your money isn't standing still. And the safety you feel doesn't come from money being untouched. It comes from the system staying in rhythm. Now, notice something subtle. On normal days, you don't need to think about the bank's role at all. Transactions go through. Money comes and goes the way you expect. Everything happens on time. But this system only works well under one quiet assumption. Not too many people will need full access at the same time. Just like a parking garage. Just like an airport. Just like any coordination system. They're not designed for a moment when everyone wants everything back immediately. And this is the key idea to hold on to in this part. A bank isn't a place that stores money for each individual in isolation. It's part of a network of promises, built on time, order, and trust that people won't all act at once. For most of your life, that trust is enough. But once you start seeing banks this way, something shifts. You realize that the stability you feel doesn't come from money simply being there. It comes from the system believing you won't need to test it right now. That's where the picture starts to change. If money isn't just being held, but is also being used while you're not looking, then what is actually happening to your money right now? That's when the question becomes unavoidable. By now, you've probably started seeing money differently. Not as something sitting still, waiting for you, but as something moving inside a system that manages flow. But there's still one critical piece missing. The piece that explains how this system can grow so large, and how it keeps working, even though there isn't enough physical cash for everyone to withdraw at the same time. So let's start with a very simple question. When you deposit money into a bank, what do you think actually happens to it? Most people imagine something like this. You give the bank your money, the bank stores it, and when you need it, you take it back. That feels reasonable, and most of the time, it feels true. But if that were all that happened, the entire money system would stay very small. There wouldn't be enough money to fund home loans. There wouldn't be enough money to grow businesses. There wouldn't be enough money to build anything larger than what already exists. So what really happens? When you deposit money into a bank, the bank doesn't need to keep all of it sitting still. It only needs to keep enough to handle normal withdrawals. The kind that don't all happen at once. The rest is allowed to move. Not secretly, not dishonestly, but exactly the way the system is designed. Your money doesn't disappear. It gets reused. And this is where most people have never stopped to think. When a bank lends money to someone, that money doesn't need to already exist as physical cash. The loan appears as a new number in the borrower's account. And to that person, that number feels just as real as yours. They can spend it. They can transfer it. They can deposit it somewhere else. And when that happens, the cycle continues. One original deposit starts supporting many different transactions, in many different places, at the same time. Not because money is magically duplicated, but because the system runs on two things: trust and time. Trust that not everyone will withdraw at once. Trust that not everyone needs everything right now. And time allows money to move from one person to another before you need to use it again. This is the part that usually changes how people see money. The number you see in your bank account isn't an object sitting there, waiting for you. It's a promise being kept inside a much larger network. There's one line here that changes how everything fits together. Your money isn't really there in the way you think it is. But the entire system depends on you believing that it is. That might sound uncomfortable at first, but it's not a trick. It's practical. If every dollar could only be used by one person, at one moment, the economy would move extremely slowly. But when money can be used based on promises, society can build far more than the amount of cash that physically exists. That's why credit cards exist. That's why mortgages exist. That's why businesses can scale faster than cash alone would allow. But for this system to hold together, it needs one very specific condition. It needs you not to question it too early. It needs you to believe that money will be available, that access will stay consistent, and that tomorrow will look like today. Most of the time, that belief is reasonable. You live your life. You get paid. You spend money. You make plans. And the system works quietly in the background. But once you understand how money is created and reused, you start to notice something important. The people who get access to new money earlier and more easily always have an advantage. Not because they're bad people, but because they stand closer to the source of credit. They can act sooner, buy sooner, expand sooner. People who rely on paychecks and monthly cash flow usually feel the impact later. This isn't an accusation. It's simply how the system works. And when you look at the world through this lens, a lot of things begin to make sense. Why asset prices can rise quickly while everyday life feels harder. Why credit conditions change before jobs are affected. Why the system often looks stable right up until trust starts to slow down. All of it comes from the same mechanism. Not physical cash, but promises multiplied over time. Once you see that, you stop looking at money as just a number on a screen. You start seeing it as part of a much larger system. One that works well as long as people believe they don't need to test it right now. And that leads directly to the next question. What happens when trust no longer flows as smoothly as before? Not when everything collapses, but when the system starts becoming more cautious. This is where most people get confused. They expect the system to either be fine or completely broken. But that's not how it actually behaves. When trust starts to slow down, the money system doesn't stop. It slows. And this is a crucial distinction. The system is designed to protect itself. And when it senses higher risk, its first instinct is always the same. It prioritizes liquidity. So what does that actually mean? It means money starts staying closer to the source. Flows become more selective. Promises that stretch far into the future get examined more carefully. There's no big announcement. No warning notification. Just small changes in conditions. Credit becomes harder to predict. Approval standards get reviewed. New loans require more steps. Not because the system is bad, but because the system is reducing its own risk. Remember, money in the system is created based on trust and time. So when trust weakens, the system has only one option. It adjusts the pace. A useful way to picture this is traffic. When everyone is driving normally, everything flows. But when congestion starts forming somewhere, traffic lights change. Some lanes get restricted. Speed limits drop. Not to stop traffic completely, but to prevent a much bigger crash. The money system works the same way. At the macro level, this shows up very clearly. Money begins flowing toward places that feel more predictable. Long-term commitments get reevaluated. Plans built on the assumption that things will continue as usual lose priority. This creates a strange contradiction. On the surface, the economy still looks like it's working. Many numbers still look fine. Companies may still show profits. But the overall mood changes. The system isn't reacting to fear. It's reacting to uncertainty. When predictability drops, the system slows down. And this is the core idea of this entire section. When the money system gets tight, the first thing that changes isn't the existence of money. It's the conditions under which money is created and moves. Money doesn't disappear, but access becomes harder and flows narrow. People closer to the source of credit feel the change earlier, not emotionally, but through terms and conditions. People farther away from credit feel it later. through everyday life, and this reaction isn't a historical exception. It's a repeated pattern in any system built on trust. Whenever trust needs to buy more time, the system does the only thing it can. It slows the creation of new promises and favors short-term stability over long-term expansion. Once you start seeing the system this way, many things that once felt disconnected begin to follow the same logic. Not because someone decided to make life harder, but because the system is rebalancing itself. And once you understand this macro reaction, the next question becomes unavoidable. When the system changes its rhythm like this, how do those changes actually show up in your life? And this is where you start to feel it. When the system changes pace, it doesn't send you a notification. It doesn't say, "We're being more cautious now." You feel it through small changes in everyday life. Let's start with what's closest to you. Credit. You're not necessarily rejected right away. Instead, you notice subtle things. Your credit limit stops increasing. Borrowing terms tighten. Familiar offers quietly disappear. Nothing dramatic happens. But something feels different. This isn't because you suddenly became riskier. It's because when the system prioritizes liquidity, credit is always the first place that gets adjusted. Credit reacts before life does. Always, next comes housing. Buying a home starts to feel harder. Not necessarily because prices jump overnight, but because the conditions around money change. Loans are harder to access. Monthly payments take up more of your income, and long-term decisions feel heavier. When money becomes more selective, commitments that stretch decades into the future are examined much more closely. Not because someone doesn't want you to buy a home, but because the system is reducing promises that last a very long time. Then there's your job. In many cases, everything still looks fine on the surface. The company still has revenue. Sometimes it even has profits. And yet, you start to notice changes. Hiring slows down. Projects get delayed. Budgets tighten. This often feels confusing. If the company is doing well, why are they being so cautious? The answer isn't in today's numbers. It's in future cash flow. When credit becomes harder to predict, every long-term plan has to be reevaluated. And when that pressure lasts long enough, difficult decisions follow. Not because workers did something wrong. Not because companies suddenly became greedy, but because the system no longer rewards expansion built purely on trust the way it used to. That's why layoffs can happen even when profits still exist. It's not a contradiction. It's a reaction. And one of the clearest places you feel this shift is in the rhythm of your own life. You don't experience a single big shock. What you notice instead are quiet changes. Cash starts to matter more. Flexibility becomes more valuable. Highly optimized plans start to feel fragile. You begin thinking twice before making long-term commitments. Not because you're afraid, but because the environment has changed. And this is the most important point of this entire section. What you're feeling is not a personal failure. It's not because you didn't plan well enough. It's not because you missed some secret opportunity. It's the direct result of how the system adjusts under pressure. Once you understand that, something powerful happens. You stop blaming yourself. You stop chasing the news every day because you can finally see the cause and effect chain. From the system, to credit, to jobs, to daily life. Nothing here is random. There's just a delay. And once you can clearly see that delay, a very natural question appears. If the system works this way, and you're living inside it, where exactly do you stand? And this is where it starts to feel personal. By this point, you understand how the system works. You've seen how money is created, how trust and timing matter, and how changes at the top slowly move their way into everyday life. So now it's time to pause. Not to predict what's coming, not to worry about the future, but to answer a much simpler question. In a system like this, where are you standing? Let's start with the most basic thing. Where does your cash flow come from? If most of your income comes from a monthly paycheck, that's not a bad thing. But it does mean something important. Your life depends quite a bit on money and credit continuing to flow smoothly. When the system runs normally, that works just fine. But when the system changes pace, paychecks are usually affected later, not first. If your cash flow comes from multiple sources, you have an extra layer of cushion. Not because you're smarter, not because you did everything right, but because you're less dependent on a single rhythm. Next is time. If you need money immediately, every small disruption feels stressful. A delayed transfer, a missed payment, an unexpected expense. Everything feels urgent. But if you have time, a few months of buffer, a few flexible options, you don't have to react impulsively when the system slows down. In a system built on trust, time is a form of asset very few people ever talk about. Then come long-term commitments. Think about the parts of your life that are hard to change quickly. Long loans, large fixed expenses, obligations you can't delay. These commitments aren't automatically wrong, but they do make you more sensitive to changes in money flow. Not because you made bad choices, but because the system doesn't reward rigidity during uncertain periods. Finally, there's flexibility. If a plan stops working, how quickly can you adjust? If one source of income slows down, how many alternatives do you actually have? Flexibility doesn't mean living without stability. It means you're not locked into a single script. And here's the most important idea in this entire section. There is no position that is inherently right or wrong. Some positions work well when the system runs smoothly. Others work better when the system changes pace. Problems only appear when you don't know where you stand. But live as if the system will never change. Once you can clearly locate yourself, something subtle but powerful happens. You stop comparing yourself to other people. You stop chasing generic advice, and you start making decisions that actually fit your reality. Not to optimize everything, but to reduce unnecessary risk. You don't need to do anything right now. You just need to see clearly. Because once you understand what you depend on, how flexible you really are, and how much time you have, your future decisions become far less emotional. And from here, one final question begins to form. Not an analytical one, a personal one. In a system like this, what do you want to prioritize so you can live more steadily? Not just on normal days, but when the flow of money shifts. So before going any further, it's worth pausing for a moment. By now, you may have noticed something important. This video hasn't been about predicting the future. It hasn't been about warning you that something terrible is coming. And it hasn't been about telling you what to buy, sell, or avoid. Because the real value here isn't prediction. It's orientation. Once you understand the kind of system you're living inside, you don't need to react to everything. You just need a few steady principles to avoid reacting the wrong way. So let's talk about those. Not as rules, not as instructions, but as ways of thinking that tend to hold up when the flow of money changes. Principle 1. Prioritize access over optimization. In a system built on trust and time, the most valuable thing isn't the biggest number on a screen. It's your ability to use money when you actually need it. Optimizing every dollar can work beautifully when everything runs smoothly. But when the system slows down, over-optimized structures are often the first to feel fragile. The question isn't, am I maximizing returns? It's, if I needed to navigate the next few months, would I have enough flexibility? Principle 2. Don't let your entire life depend on one flow of money. Having a single source of income isn't automatically a mistake. But depending entirely on one flow makes you sensitive to changes you don't control. Reducing dependence doesn't always mean earning more. Sometimes it's simpler than that. Lower fixed costs, fewer rigid commitments, more room to adjust when needed. Diversification here isn't about getting rich quickly. It's about not getting stuck when conditions change. Principle 3. Time is an asset, even if it doesn't look like one. Most people don't think about time as part of a financial picture. But in a system with delays, time is often the biggest advantage. Time means you don't have to decide in panic. Time means you don't have to accept bad terms. Time means you can wait until things are clearer. Not everyone has a lot of time, but almost everyone can avoid making it even shorter. Principle 4. Don't optimize for a single scenario. A lot of financial advice quietly assumes the future will look like the past. But this system changes pace in cycles. Living more safely isn't about guessing the right scenario. It's about not being completely broken when a different one shows up. Choices that allow adjustment tend to age better than choices that lock you into one path. Principle 5. Understand the system so you don't misinterpret signals. When you understand how money is created, why the system slows down, and how changes move into daily life, you stop being pulled around by every headline, not because you don't care, but because you can see what actually matters to you. You don't need to react to everything. You just need to notice what's changing near your position. And that leads to the final principle, the one most people never talk about. Calm is a competitive advantage. In a system built on trust, panic is always the greatest enemy. Not because panic is morally wrong, but because it leads to bad decisions at the worst possible timing. Understanding the system doesn't make you immune to risk, but it gives you something rare. The ability to stay calm when others feel forced to rush. And sometimes, that's all you need to live more steadily inside a system like this. So let's slow down and put all of this together. Not with a prediction, not with a warning, but with a clear way to think about money without fear and without illusion. By this point, you may realize something important. The modern money system isn't good or bad. It doesn't care if you understand it, and it doesn't care if you don't. It simply runs according to its own logic. A logic built on trust, timing, and coordination. Most of the time, that logic feels invisible. You get paid. You spend money. Life moves forward. And as long as things feel normal, there's no reason to question any of it. But now you've seen what sits underneath that normal. You've seen that your bank balance isn't an object waiting for you. It's access, under certain conditions. You've seen that money doesn't sit still. It moves, circulates, and gets reused. And you've seen why the system feels smooth when trust flows freely, and tightens when trust slows down. None of that means you need to be afraid, and none of it means you need to take drastic action. Understanding the system isn't about trying to outsmart it. It's about not misunderstanding it. Because the biggest mistakes people make with money don't come from lack of intelligence. They come from reacting to the wrong signals at the wrong time. Once you understand how this system actually works, you stop expecting it to behave like a vault. You stop assuming that today's conditions will always hold. And you stop confusing temporary friction with permanent failure. That's where calm comes from. Not from pretending risk doesn't exist, but from knowing where it actually comes from. You don't need to predict the future. You only need to understand the kind of system you're living inside, and choose how to live in a way that fits that reality. That's not how you win fast, but it is how you avoid losing when the direction suddenly changes. And that, more than any number on a screen, is what real financial stability looks like.